Howdy everybody, welcome back to Principles of Financial Accounting, Accounting 1101. I'm Professor Martin with you as always, trying to lay out the accounting in a way that you can understand it and hopefully learn it. In our video right now, we're going to be looking at journalizing transactions, and literally journalizing a transaction means just like you journalize anything else, you write it out. I keep a little journal when I go on vacation and kind of write out what goes on any given day, and so I can look back and finally remember it, and also so I can have a record that way, 10, 15 years down the road when I say, hey kiddo, you remember that time in Cedar Rapids, Iowa, we were at the minor league baseball game and you dropped a foul ball and lost a souvenir? Boy, that was awful, wasn't it? And then she might say, oh, I didn't do that. But no, I've got a record. It's right here in the journal. You dropped the foul ball. What a terrible thing to have happen on vacation. So a journal gives us a permanent record of transactions, just like my vacation journal there. And so it's important to understand how to journalize transactions, because that's really where it starts. That's how we get things into the accounting system, via a journal. So that's what we're looking at today. If you remember our previous video, we talked about the T account, and we talked about accounts, and we talked about putting transactions into the individual accounts. We're still doing that, but we're going to put them in journal format before we put them into the individual accounts. From last time, you should know about the T account. You should know about debit and credit, left and right. And you should also understand that debit and credit tells us whether an account is going up or down, depending on what side of the account the number's on and what type of an account it is. We discussed the rules behind all that. And I mentioned in doing that, it may take a while for you to get the rules down. It may not be something you get right off the bat, but if we look at it enough, eventually you'll become comfortable with it. And we kind of gave you the little diagram you see here to show you all the rules in one place. On the balance sheet, we talked about how if we were an account living on the the left-hand side of the accounting equation here, you go up on the debit or left-hand side of the account. We talked about how if you were a liability or an equity account on the right-hand side of the accounting equation, you went up on the right-hand side or the credit side. We talked about income statement accounts. We talked about revenue accounts and expense accounts and showed you the rules for that. Revenue accounts go up on the credit side. Expense accounts go up on the debit side. So again, it's going to take some time to learn the rules behind that, but I think you'll get it eventually. In our video right now, we're going to use a journal to record transactions. As I mentioned, that's really where transactions begin. That's how they get into the accounting system. They're entered into a journal, and then they're copied over to the individual account. Our journal looks like what you see right here. We have a few columns here. Obviously, the date the transaction occurred. The account column is going to be for the accounts involved. We have a column called posting reference, which is simply what account number the transaction went into. We have a debit area and a credit area. And so we're going to enter transactions into our journal. We're still going to use our example business, Net Solutions. In fact, the information that we're going to be entering into the journal, we've already kind of looked at the transactions before last week during our video. So we're going to be looking at the exact same transactions, only we're going to be showing you how to enter them into the journal. So here we go. Transaction A. We have Clark. Chris Clark, you remember, the founder of the company or the business, Net Solutions. He started off by putting $25,000 into a bank account in the name of Net Solutions. So he's funding the business here. And so we want to start off by putting that into a journal entry. We're journalizing that transaction. Our first step in doing that is to kind of look and see what's going on. All right, we're putting $25,000 into a bank account. You read that, you think, okay, we have a cash account going on. We're putting money into the cash account. Cash account needs to go up. Who's putting the money in? Well, the owner is. Owner's investing. So we have a capital account in play here that needs to go up. All right? And I've got those two accounts down here underneath the accounting equation showing you the account impact. And remember our rules here for trying to make the cash account go up. Cash is on the left-hand side of the accounting equation. So it's going to go up on the left-hand or debit side of the account. Capital's on the equity side, on the right-hand side. So it's going to go up on the right. And then down on the left. All right. Now, before I journalize it, I just want to point out this is a great opportunity. If you want to follow along, you can print out these notes and kind of follow along with me and take notes by hand. You can take notes on paper if you don't have a printer. But this is definitely something that you're going to want to write down and kind of follow along with, because I really do think that there's a strong connection in writing something out and getting your brain to remember it. And it's just some kind of magic that happens there mentally. So take the time to print these off. Take the time to kind of write stuff out by hand. Follow along as we go. I'll do my best to write neatly so you can read it. I'm not going to make any promises. I don't have the neatest handwriting in the world. I'm somewhere between probably a 10-year-old and a doctor. You know, doctor scribbles on the prescription pad there. So I'm somewhere in between there. I'll do my best. Our journal entry. We're going to put a date. 11/1. Now, when you're making journal entries, you don't have to put the date on every single line. Put it one time per transaction at the beginning of the transaction. I need to make that cash account go up. It's going to go up on the debit side, so I'm going to start with my debit. I want to write out cash. 25,000 was the amount. That's my debit. Where did that 25,000 come from? Well, it came from an owner investment. You can see we got Chris Clark Capital. It's going to go up on the credit side. So I'm going to go ahead and credit Chris Clark Capital. You guessed it, 25,000. So that's my entry. Debit cash, 25,000. Credit Chris Clark Capital, 25,000. I can use a blank line at the bottom to write a description of the transaction. You'll get to the point where you can look at a transaction and know what happened without getting a description for it. But for now, we'll go ahead and put in a little description here. Owner's investment. That's what happened. Owner invested into the company. I didn't put any numbers next to that. That's just a description. So that's a pretty good looking journal entry right there. That's where the transaction is going to begin. It's going to begin by being entered into the journal. And then we'll post it over to the individual accounts. We'll have a separate video where we kind of show you all the posting. But just to give you a little heads up, I'm going to copy the entry right into the appropriate accounts. That's called posting. I took the journal entry for cash, copied it to the cash account. I took the journal entry for capital, copied it into the capital account. Notice I didn't flip it. I didn't move it around, flop it around or anything, reverse it. No. I had a debit for cash. I copied it to the debit side. I had a credit for capital, copied it to the capital side. So it's the exact same thing that we looked at in week 1, only now we're doing more like what we do in real life. We journalize it and then post it to the individual accounts. So we're going to go through and we're going to look at every single transaction that we've already covered, putting it into the journal, posting it over to the individual accounts. So the steps that I took right there, a few different things I did. Number 1, read the description of the transaction so you know what's going on. You have to read the transaction, analyze it, figure out what's going on. Step 2, determine what accounts are in play, what accounts are affected by the transaction. I did that. I said, okay, cash is coming in, the owner invested it, cash account, owner's account, equity, capital account in play. Step 3, determine if the affected accounts are going up or going down. I said, okay, well, cash is coming in the door, cash is going up. Follow the rules of debit and credit to determine what side of the account to hit and then make your entry. That's it. Every time you see a transaction, you're kind of going through that process, analyzing it, figuring out the accounts in play, figuring out if they're going up or down, and then figuring out how to make them go up or down via your entry. All right. Transaction B. Net Solutions paid $20,000 for the purchase of land as a future building site. So down here in the accounting equation, you can see I got 2 accounts. I got a cash account. I've got a land account. Net Solutions paid $20,000 for the purchase of land. So they paid cash accounts in play. They bought land. land accounts in play. Both accounts are assets. They're on the left-hand side of the accounting equation, meaning they go up on the left-hand side. They go down on the right-hand or credit side. Remember, left-hand side, debit, right-hand side, credit, every account. Debit's always left, credit is always right. So as we're looking at that, one account has to go down, one account has to go up here. The land is going up, the cash is going down. So let's go ahead and journalize that. 11.5. Land moving up to the tune of 20,000. 20,000 bucks. And our cash account is going down. Right early on, you can draw out your T accounts and you can label the pluses and minuses if you need to, if it helps you to kind of visualize everything. But we're going to start off always by journalizing the entry. And then we'll post it over to the accounts. So my land account has gone up 20,000. My cash account has gone down 20,000. A little description if I wanted to. Bought land. It doesn't have to be anything fancy, just describe what happened. We bought land. There we go. This is accounting. Easy, right? Everybody should do accounting. It's just that easy. All right, let's move on. The correct journal entry format. I've made 2 journal entries, and you notice I've done them a certain way. First thing, 1 date per transaction. I mentioned before, we don't write 11.5 3 different times. That's going to be really hard to read. We put 1 date, the very first line of the transaction. Okay? That's all we need. 1 date per transaction. We put the debits on the top. Notice I have my debit entry on top. On both of those transactions that I've done, the debit went on top. Not a law that says you have to do that. It just makes it easier to read. It's convention. It's best practice. We put the debits on top, we put the credits underneath, and we indent them. Again, makes it easier to read. Debit, credit on the bottom, indented, easy to read. Optional description at the bottom, and then the biggie, the entry has to balance. If your entry does not balance, it is 100% wrong. It will never, ever, ever be right. If you ever make an entry that doesn't balance in dollar amount, it's wrong. I don't care what it says. It's wrong. It just is. It's a universal accounting truth right there. So we look at my entry. Do the debits equal credits? Yeah, you bet you. 20,000 bucks on the debit side, 20,000 on the credit side. Debits equal credits. We have a balancing entry. Transaction C. Net Solutions bought supplies for $13.50 and agreed to pay the vendor in the future. All right, now I'm going to go ahead and pause the video. So I don't want this to be too long. I want to go ahead and pause. If you want to try to go ahead and make the entry using what you know, go for it. And then I'm going to write out the entry so you don't have to watch me write it, save a little bit of time, and then we'll come back and maybe compare notes and see how we did. Okie dokie. So we had Net Solutions buying supplies. They paid $13.50 and agreed to pay later on. They're kicking the can down the road. They owe the vendor money for the supplies. We call that an accounts payable. So our 2 accounts in play here, supplies and accounts payable. You can see our supply account needs to go up because supplies are coming in the door. Increase with a debit to that supplies account. And then liabilities are going to go up to reflect the fact that we now owe money. So we need to make the liability account go up. It's on the right-hand side of the accounting equation, so we do that with a credit. Supplies debit, accounts payable credit, and then I've copied them to the account, posted them to the individual accounts right there. Let's see, transaction D here, there we go. On November 18th, Net Solutions completes a job for a customer and is paid $7,500 in cash. We got a little revenue transaction here. You can see our fees earned revenue account. We have a cash account. Once again, I'm going to pause. I'm going to go ahead and fill in the journal and then post our numbers over to the individual accounts. I encourage you to pause as well. Get out your handy pen, write it out, see if you can work ahead here, and then we'll come back. We'll compare notes. Alrighty, so I've got our journal entry made. Hopefully you have the exact same thing. We have a debit to the cash account, $7,500. We got a credit to our revenue account, fees earned. My description, received cash on a completed job. And so, okay, how do you know to debit cash? How do you know to credit fees earned? Remember our rules of debit and credit. Cash is an asset account. It lives on the left-hand side of the accounting equation. It means it goes up on the left hand or the debit side. That's how I determine my debit. My fees earned is an income statement account. It's a revenue account. Revenue goes up on the credit side, the right-hand side, and it goes down on the debit side. So that's how I knew what to debit and what to credit, because I have the rules memorized. I'm not a genius by any stretch of the imagination. The reason I have them memorized is because I've been doing them for 20 years. All right, I'm getting old. But you do something for 20 years, it's pretty easy to remember it, right? You may not have 20 years of experience, but you can remember them too. Just take some time. Let's do another transaction here. On transaction E, we have a expenses going on here. We got Net Solutions paying expenses in wages, rent, utilities, and miscellaneous. It paid for them in cash. So all kinds of expenses being paid here on November 30th. Once again, I'm going to go ahead and journalize the entry. I'm going to pause while I write that out. You can go ahead and give it a stab to give you a little hint. All of these are going to be expenses here. Wages expense, rent, utilities, miscellaneous expense. All of those are income statement accounts. To make an expense account go up, we hit it with a debit. The cash account's going to go down for the total of all the expenses we paid. Asset account goes down on the credit side. So we're going to have some expense debits and a cash credit when we come back. Here we go. Hopefully you had a chance to write out your entry. Hopefully it looks like what mine looks like. I've got my wages expense, rent, utilities, miscellaneous, all on the debit side because expenses go up on the debit side of the account. And then I have a cash credit to reflect the fact that I have taken money out of my cash account to pay all those expenses. Cash account has gone down. Now, you might look at that and say, wait a second, you told me debits equal credits. You've lied to me already. No, I didn't lie to you. Yes, we have more debits than we have credits. In accounts, we have 4 debits, 1 credit. But the key, remember, the key is not how many debits and credits you have in accounts. The key is, do they balance in dollar amount? I had to add up my debits here. I added up 2125, 800, 450, and 275. And that gave me $3,650. That's the amount of cash that went out the door. So we have to balance in dollar amount. Debits have to equal credits in dollar amount, and they absolutely do in my entry. So I didn't lie to you. Debits equal credits in dollar amount. We get to post it over to the individual accounts. We saw the $36.50 credit to the cash account. We know, as we've seen from our entry, expenses go up on the debit side. And so we have our wages was $21.25. Our rent was $800. Utilities is $450. Miscellaneous is $275. We can call that part posting. We journalize it and then post it over to the individual accounts. Now, again, just to reiterate, the key point there, it doesn't matter how many debit and credits you have as long as the two sides balance in dollar amount. Debit dollar amount equal credit dollar amounts in total. All right, we have to have at least 1 debit and 1 credit. Otherwise, we wouldn't be able to balance it all. But in dollar amount, that's what we're shooting for. Debits equal credits in dollar amount. Another entry, Net Solutions paid back $950 of the amount they owed on account to the supply vendor. Remember, we owed $1,350. That's what we owed. I'm going to just go ahead and put that right there. That's where we started. We owed $1,350. Now we're paying back $950 of what we owed. You need to make an entry for that. I'm going to go ahead and pause. I'm going to write out my entry. You can go ahead and give it a shot as well. Sitting there playing along at home, we'll see how we did. Alrighty, 2 accounts in play here. We had an accounts payable where we owed the vendor, where we bought supplies but didn't pay them right away. And then we have a cash account where we're actually paying back some of the money that we owed here. And so two accounts in play. The first account we're going to hit is accounts payable. We're going to hit that with a debit. As we know, accounts payable is on the right-hand side of the accounting equation. Goes up on the right-hand side or the credit side. We don't want to make it go up. We want to make it go away because we're paying back. We paid back $9.50. All right, so there's my debit. Cash account comes down because we paid money out of it. We don't have that money anymore. Goes down with a credit. So after that transaction, we can look and see that we owe $400 still on that accounts payable. We began owing $13.50. We paid back $9.50. A positive $13.50 minus $9.50 gives me $400. So I still owe $400 on the supplies. Moving right along, we have November 30th. Net Solutions counted their remaining supplies and determined they had $550 left over at the end of November. Now, we talked about it back in week 1 when we're talking about supplies. We buy a big load of supplies, we put them in a supply closet, and we pull them out when we need them over the course of the period. Now, it's not really efficient every time we grab a pack of Post-it notes to make an accounting entry for that. So what we do is we just wait until the end of the period and we make one entry. We go in and count what's left over, and then we make an entry for what we've used up. Our problem here says we are down to $550 left over. We started with $13.50. So we need to make an entry that will take all the supplies we've used up out of supplies and record an expense for it. All right, we began with $13.50. We're down to $5.50. So we need to make some kind of entry that will bring that account down. $13.50 minus $5.50 is $800. I'm going to go ahead and make the entry. You can do the same. We're making an $800 entry to reflect the supplies we've used up during the month of November. So there's our entry. You can see I've got a debit to supplies expense, $800, a credit to supplies, the asset account for $800, supplies used in November. Now, why did I put that on the debit side for supplies expense? Supplies expense is an expense account. We know they always go up on the debit side. The supplies asset account, what we actually have in the closet as an asset that we physically have, ready to be used. We have $550 left over. We started with $13.50, so we needed to take out $800. We've used up $800 of the supplies we've had on hand. So there you go. That's our debit and that's our credit. We've basically taken out $800 from the closet, used it up. Recognize the expense, take it out of the asset account because we don't have it anymore. One more transaction. I appreciate you hanging in there. I know it's been a flurry of accounting activity, and we got one more, and we will be done. So final transaction here in the video, we're looking at a draw. The owner has decided to take money out of the business, Net Solutions, and we need to record the fact that they've taken $2,000 out for personal use, and they've withdrawn money from the business. You can see the accounts in play here. We've got our cash account, of course, and we have the drawing account. The drawing account is very similar in function to an expense account. Now, draws don't count as an expense. They're not going to count it against net income, but kind of functions in the same way in the sense that it's going to go up. We're going to record draws on the debit side. Now, cash account, of course, we already know it goes up on the debit side and down on the credit side. All right, so we're going to give you a second, pause, see if you can make this entry happen, and then we'll talk about it. All righty, there we have it. You can see we've got a debit to Chris Clark draw or drawing account there. And as I mentioned, just like an expense account, it has a normal debit balance. Cash account gets hit with a credit because cash is going out the door and the account needs to go down. So there we go, our final transaction. At this point, we would have all the transactions done for the month of November. But you might think, well, wait a second, when we did this last time, we had nice ending balances. when we just plugged everything into the accounting equation. We had all these nice little ending balances for all the accounts, and I could see what the ending balances were. Where are my ending balances if I do what you just did? And I journalize it and plug it into a T account. It's okay. We're going to get there in the next video. I'm going to show you how we take those journalized entries and post them over to the ledger accounts, which are the individual accounts, and we'll use that to create our ending balances. And that way we can know what is in every individual account in kind of like real time. So we'll get there. No worries. As we're getting there, if you have any questions as you're working through your homework, as you're listening to the lecture videos, whatever the case might be, I'd be happy to help. What we're doing here is we're building an accounting foundation. Okay? And you think about building a house. You got to build a foundation before you put the walls up and before you put a roof on. If you don't have a good solid foundation and you try to put the walls and the roof on, what's going to happen? It's going to collapse, right? So we're building the accounting foundation. It's very important here in the early going of accounting. If you get lost, if you don't understand what's going on, don't wait. Don't put it off. Reach out to me. Let's talk about it and try to get you back on the right path, because we've got to make sure that everybody builds a good, solid accounting foundation. Until next time, take care, everybody.